Good afternoon, everyone, and welcome to today's program, Government Closures of Silicon Valley Bank and Signature Bank, What Lawyers Need to Know, sponsored by the Business Law Section and the Banking Law Committee of the Business Law Section. Today's session will run from 3 p.m. to 4 p.m. And during the live webinar, participants will pose questions using the Q&A feature in the Zoom portal. And now I will hand it over to the Business Law Chair to start us off, Thomas Pittigoff.
Hello, everyone, and thank you for attending this program. This has been put together amazingly quickly, and I give a lot of credit to Jay Hack, who instigated it and just worked amazingly quickly, along with the State Bar staff, and I'm looking forward to hearing the program. I would encourage everyone who's on this, who's listening in, to join the State Bar, if you're not a member, to join the Business Law Section and the Banking Law Committee, where you can stay in touch with your peers, you can network, you can influence legislation, and just have a great time. So thank you. And Jay, I will let you take it away and introduce the speakers.
Okay, let's see. Thank you all for coming, attending. This is a moving target, I must admit. So please be careful. What you heard day before yesterday isn't what you're gonna hear today. And things are likely to change, so you're gonna have to tune back in to any follow-up that we do. I will tell you that Jeff Marsico, who is in Hawaii right now and is the president of the Kafathian Group, a bank consulting firm, has agreed to join me on this presentation. Because we're putting this all together quickly, we haven't really talked in detail about exactly what each of us is going to say, but I'm hoping that Jeff is going to be able to give you some guidance and explanation about the liquidity crunch issues which are being talked about, are very important here, and there's a massive amount of misunderstanding on the issue. So I'm hoping that he can straighten this out for you. Unfortunately, a lot of the people who we thought would be great speakers here ended up, how do we say politely, Jeff? Bailing on us due to cowardice? No, okay, yeah, that's sort of true. Regulators can't speak because their bosses won't let them. Companies involved in this employees can't speak because their bosses won't let them. Former regulators, one senior one that I spoke with a lot over the last 4 days, bailed on the last minute because he was afraid of who would be listening in, and his opinions were kind of harsh and he didn't want to get a reputation for it. So we're going to just start off, tell you what we can about what has happened and to some extent why it has happened, and then we're going to move into the core issues of attorneys, their funds, and their escrow accounts. I was joking a few minutes ago that, of course, we're not going to talk about the FDIC insurance limit and the effect of that on attorneys. The answer is yes, of course we are, but hold on that for a little while because we want to give you some background first. The most important bit of background that I'd like to give everyone is that rumors, false facts, and bad analysis are all over the place on this issue. We've been, I really can't decide whether I'm an attorney or a fireman because I've spent the better part of the last 3 days putting out fires resulting from misinformation involving everything from why the bonuses paid to the Silicon Valley Bank officers caused the closure. Of course it didn't cause the closure. It was paid the day before, 2 days before the closure. The money, it was insignificant. So please be very careful when you see things written by other people, including, I might add, Nobel Prize winners in economics who have made gross misstatements about what's going on here. Be very careful. Look at the facts, particularly with respect to the banks. Look at their financial statements before you conclude what actually happened based upon a story that your friend's cousin's uncle told you. Now, what were the causes of this problem in the first place? And the answer is what we would call a liquidity crunch or lack of liquidity in the financial institutions. What appears to have happened, and this is partially from public reports, but also from doing a deep dive into the quarterly financial reports of Silicon Valley Bank, is that Silicon Valley Bank did not have enough liquid assets to pay demands of depositors. Now, a lot of people think that when a bank takes a deposit, they put the money in a bucket and they put the bucket in the vault and it stays there so that when the customer comes in and says, give me my money, they go in, they take the bucket, they take the cash out and they give it back to the customer. That could not be further from the truth. And if you think about it, it couldn't possibly be true, because otherwise the bank wouldn't have the ability to pay interest on deposits. If the money was sitting in the vault, where were they going to pay interest on deposits? If the money were sitting on the vault, how could they pay salaries? How could they make loans? Where would the money come for that? Look at the billions and billions. I don't know. Jeff may know the number. I don't know what the number is, of municipal bonds that are owned by banks. Where would they get the money to do that? And the answer is they take the deposits, they redeploy the deposits in investments. What happened with Silicon Valley Bank is too many depositors, or actually not a lot of those, too many very large depositors came in and demanded their money all in a very short period of time. Why did they do that? A lot of reasons. Hard to say yet. Eventually, I'm sure there will be congressional hearings and we'll figure it all out. But too many people came in too quickly and asked for their money, and Silicon Valley Bank didn't have the cash available. Why didn't they have the cash available? There are probably about 30 different reasons, one of which certainly is that they were investing in longer term securities. By the way, another incorrect statement. They weren't investing in long-term securities starting in mid-February. If you look at their quarterly financial statements, which are available on the FDIC website, and which I did a deep dive on Friday night and Saturday morning, their investments in long-term fixed rate investment securities started sometime during the third quarter of last year. Was that a good decision or a bad decision? Well, with 2020 hindsight, of course, it was a horrible decision, but whether it was a good decision or a bad decision at the time can be debated. Sorry about that. It can be debated. But they made those investments and they didn't have, I apologize. I'm going to just disconnect my telephone. There we go. Whether that was a good decision or bad decision can be debated, but it was made. And the consequence of that, coupled with some rumor mongering and some unfortunate statements by some venture capital people, was that large amounts of money, huge deposits, were withdrawn in the last week or two. And the government came in on Friday and said, okay, you're not going to be able to make your pay your depositors withdrawal requests. We're going to shut you down. That was announced on Friday. This is standard in the industry. They always shut down banks on Friday. The last bank that I know of that wasn't shut down on Friday was Liberty Point Bank in New York, and it was shut down on Thursday. And frankly, the reason for that was very simple. It was a Orthodox Jewish community bank, and there wasn't going to be anybody at the bank on Friday afternoon, so they shut it down on Thursday. But other than that, this is standard procedure for the government bank regulators. They shut you down on Friday. They put little signs on the door that say, come back Monday morning, and they spend the weekend straightening things out so the depositors can withdraw their money on Monday morning, and it's seamless. And as to the $250,000 deposit limit, it has in the past been pretty seamless, even in situations like 2008, when they were closing so many banks that some of them had to close on Wednesday because they didn't have enough staff to do them all on Friday. What happens, though, is that when the bank closes, there's 2 days worth of panic building up because people can't get their money, and it's worse now than it was. If you think about it, with the internet, everybody knows everything and everybody hears everything. So the panic started to build up. By Sunday, government bank regulators and Secretary of the Treasury Yellen, exactly who was the decider, I don't know, said, whoa, we got this problem. First of all, we've got Signature Bank, which is facing the same issues and is liable to be unable to pay its depositors within a few days. We're going to have to shut it down, and that's going to make 2008 look like a cakewalk, because we've got two big banks with a lot of money and a lot of panic. And we've got to do something. So what the government did was, and we're getting to sort of the answer to the FDIC insurance question, was they said, we're going to have to lift the insurance limit because we don't want panic among people who have $450,000 and they're going to be afraid that they're going to lose $200,000. And more important, we don't want the bank next door that is not in trouble to suffer from the same problem, because everybody's going to go in, and say, I have $450,000 in the bank. I'm taking $200,000 out right now because if you fail, I'll lose that money. The consequence of which is this giant spiral in which that bank then has a deposit outflow. Yeah, it's going to eventually end up in another bank because people want it, but it's going to take time and it's going to cause more panic. So the government said, we've got to shut this down. And the government said, okay, we're going to do three things actually. First of all, we're going to lift the deposit insurance limit for what are called SIFIs, systemically important financial institutions. Second of all, the Federal Reserve is going to provide liquidity to Silicon Valley Bank and Signature Bank to allow the withdrawals to be completed, because they really didn't have the buckets of cash. And third of all, we're going to change the rules a little bit regarding, and I haven't had a chance because I've been doing so many other things. I'm not sure it's the Fed discount window. Jeff, you may know the answer to that question. The federal government said, we're going to facilitate the ability of banks to borrow money against long-term assets, like a 30-year treasury bill, so that if they need it for liquidity purposes.
Yeah, the Fed set up a special fund for that purpose in case there was a contagion that banks could access.
Yeah. Basically, so for those who want to know who do I thank for the fact that I can get my money, the answer is the Federal Reserve. You may not like the fact that they can print money, but this time their ability to print money was a big plus. So the collapse, I think we faced a serious potential disaster. Some people disagree how bad it would have been. Some people would have been very happy if it had been bad. But in my view, we faced a potentially very serious disaster, and the disaster was averted. The panic was averted because of what happened. Now, what did the government do? It lifted the insurance cap. It provided funds for future problems through the purchase of non-liquid or of long-term or otherwise non-short-term liquid assets. Why did the government do this? Well, for those of you who've been around through the prior banking collapses, and I hate to say this, we have 1980, we have 1989, and we have 2006, 7, 8. This is unfortunately a repetitive problem. We can talk about how to solve the repetitive problem again, but we're going to do that another day because it was tried in Paul Volcker tried it in the early 80s. FIREA tried it in 1989. Dodd-Frank tried it in 2009 or 10 by the time they got around to it. We haven't solved the problem yet, but eventually maybe they'll figure it out.
I think, Jay, it's because the
Yeah.
problems are always different. We're always solving in the rearview mirror, and the problems are always different. And I think it's interesting you brought up Dodd-Frank, given that Barney Frank was on Signature Bank's board for the past 7 years.
You learned something new. I didn't know that.
Yeah, there you go. I think so. Banking is a trust and confidence business, and when depositors lose confidence in a bank, it's almost the same as the bank run scene in It's a Wonderful Life. Just as Jay said, banks don't keep your money in the vault, they're lending it out to somebody else. So large scale withdrawals would be difficult for any bank to be able to withstand. And at the request for withdrawals of Silicon Valley Bank as a percent of their total deposits, no bank could withstand.
No way.
So the dominoes that started, what makes it a little disturbing in our opinion, and I think it's important that if you guys serve bank clients, that we continue to talk confidently about the quality of the banking system, because the dominoes are so unique for Silicon Valley. And even though Signature caught the cold, they had different, slightly different business models. But Silicon Valley had deposit outflows all through 2022. They weren't loaned up. They had a relatively low loan to deposit ratio. So that made them look to yield in their investment portfolio, which caused them to lengthen that investment portfolio. But worse, there was an accounting convention. You either put your securities in an available for sale bucket called AFS or a held to maturity bucket called HTM. And the HTM securities outsize the AFS securities 2-to-1. If you're in the HTM bucket, you don't have to mark those securities to market quarter after quarter. But if you took the cumulative loss in the HTM portfolio, added.
Whoops. Jeff, I think your connection from Hawaii may have glitched, but and I haven't heard Jeff say this, but it's like I wrote it. I mean, it's unbelievable because his analysis of mine are the same. If you just because I know that this is not a common understanding among lawyers, but what happened was, and it started in the third quarter of last year at Silicon Valley Bank, they went out and they started buying long-term securities. Why? Because rates were going up. They didn't have a lot of loans, which makes it fundamentally different from let's say the problems that existed in 1980 and 2008. They didn't have loans. Their loans were, I think, 41% of total assets. That's extremely low. So they went to chase yield because they needed to make money. Rates were going up, so they went and they bought long-term securities. They didn't buy them in February of 2023. They started buying them sometime during the third quarter of last year. We don't know exactly when, only because we only have quarterly data, but they started buying those securities. And as a result, and they, as Jeff was about to say it when he kind of got lost, they classified them as what is called held to maturity. For those of you with a good accounting background out there, what that means is that they are accounted for on a excuse me, on a historical cost basis. That means that if you buy a 30-year treasury bill and it is currently paying 4% and you pay $1 million for it, it's on your balance sheet at $1 million. If the market rate of interest goes from 4% to 5%, that treasury bill is worth less. It's not worthless. It is worth less than it was when you bought it, but you don't have to reflect that loss on your income statement. So you look.
I'm back now, Jay. Can you hear me?
Yeah, great.
I turned off my video. I just think the lawyers rejected my face. That's what happened.
Oh,
here.
well, that was obvious.
Yeah.
I was just
So,
explaining
yeah.
to them what
The HTM.
Yeah.
I was listening, and you were doing a really good job about doing it. But yeah, so 2/3 of their investment portfolio was HTM, and they made $417 million, Silicon Valley Bank, in the fourth quarter of last year. Their non-performing loans, the total loans was less than 50 basis points. This wasn't an asset quality issue. This was simply a liquidity issue. But they did lose deposits last year because they are heavily concentrated in venture funds and the founders' businesses. So what would happen is if you would go out and raise a $20 million capital raise for your business, you would be encouraged generally by the lead investor to put it in Silicon Valley Bank. You put $20 million, only $250,000 of which is FDIC insured. You'd put the $20 million from your capital raise in Silicon Valley Bank, and then you would commence to burn it, as startup firms tend to do. Silicon Valley Bank specialized in doing bridge loans to your next round of capital. So the next round of capital was becoming more in doubt because the venture funding, they're starting to insist that for their portfolio companies to start thinking about profitability, not their next round of funding. So they were burning down their capital, and it was showing in SVB's deposit base and the decline in their deposit base, but they were making money. And then the Founders Fund, run by Peter Thiel, did a capital call to their investors for their fund to reinvest in startup companies. And the capital raise, the investors were having trouble accessing Silicon Valley Bank to deposit their money. And then that Founders Fund went and did it at other banks. And then Peter Thiel also suggested to his portfolio companies that it wouldn't be a bad thing if they pulled the money out of Silicon Valley Bank, because he was detecting problems. I'm not sure I would have done anything different than Peter Thiel did at that point in time. But the problem is with the amplification power of social media, and Peter Thiel doesn't tweet. If you look at his Twitter feed, there's no tweets, even though he has 300 and some thousand followers, right? But the amplification power of social media just created this megaphone and a classic run on the bank. And as Jay said, when he referred to the internet, a run on the bank doesn't mean you line up in line. If you remember back when Indy Mac failed out in California, I think Chuck Schumer sent an open letter to the OTS worried about the bank, and they had a classic line up of people trying to get money out of the bank. But for Silicon Valley Bank, you could just sit in your hotel room and try to withdraw money from the bank. So they had, I think in the course of less than 1 week, $40 billion of requests for withdrawals. They couldn't even last Friday. Jay mentioned that they closed on Friday. Normally, the regulators will come in with blue suits. I don't know if they still wear blue suits at the end of the day on Friday. If you see
Right, it was midday.
right? They had to do it midday because Silicon Valley Bank could not withstand the onslaught of withdrawal requests. And this happened to be happening to Signature Bank. Signature Bank actually did not have those long-term bond portfolios, did not have the majority of their bond portfolio in held to maturity like Silicon Valley Bank did. They actually, Signature is about half the size of Silicon Valley Bank, and they had 25 billion of their 110 billion in assets in securities, 18 billion of which were available for sale for liquidity. So I think when you hear some of the Signature Bank commentary, you'll probably hear that they didn't need to fail because they had plenty of liquidity. But the regulators came in on Sunday, very unusual day for the regulators to close a financial institution because they thought that the contagion traveled to them. Both of those banks had a very significant portion of their deposit base above the FDIC limit. I think Silicon Valley Bank might have been 94% and Signature might have been 90%. So the two failures were a crisis of confidence in the banking system, not asset quality driven. It was a crisis of confidence, and they had a classic run on the bank that almost no financial institution could have withstood. So I guess the message is that we have to inject confidence back in the system. And I would say that aside from the moral hazard, I know one person, Jay, in our Q&A asked about the government insuring deposits over $250,000. And since they committed to paying out all the deposits at Signature and at SVB, they are de facto insuring those deposits over $250,000. So the moral hazard for the government is that they de facto insured all deposits over $250,000, which means if you're a bank attorney, that the FDIC Insurance Fund is going to increase its assessments to your clients to repopulate that FDIC Insurance Fund.
Yeah, if you look at the history of bank issues in the United States, at least going back to the late 70s and early 80s, there was a problem in the late 70s and early 80s. What was that problem? It wasn't confidence. It wasn't asset quality. It was that there was what we would call negative spread. Interest rates were going up so fast, and the banks had assets that were yielding not very much, and they were paying a lot more in deposits. In 1989, it was an asset quality question. The lot of savings and loans had invested for reasons that get a little complicated in assets that weren't doing very well, and they failed. Again, in 2008, it was the same thing. It was an asset quality question. As the value of real estate and the problems with mortgages compounded, the banks had asset quality problems, and they were flat out losing money. The difference here, and it's the important thing to remember from a confidence point of view, is there was Silicon Valley Bank had probably business plan problems, but they weren't losing money. And Signature Bank had may have had lesser but similar business plan problems, but they were perfectly profitable. They were making money. It's just that the panic resulted in an imbalance between assets and liabilities, and that causes an issue. Not an imbalance because you had more liabilities, because the liabilities stay there until you pay them out. But the imbalance was the need to use the assets to pay the liabilities when the liabilities were demanded. This is not like a regular business where you've got where your liabilities consist of things like bonds and stuff like that. A lot of people have said to me in the last couple of days, well, couldn't Signature have just said, we're going to wait a week and we're not going to pay out those liabilities. We're going to wait a week while we convert our assets into liquid assets so that we can pay them out. And the answer is, this goes back, I may be old, but I'm not that old. This goes back to the Rooseveltian banking moratorium during the Depression. The answer to that question is no. Banks aren't allowed to say, we promised to give you the money, but we're not going to. That's what, or we are not able to, that's what causes them to fail. So this was fundamentally different from those of you who were around in 2008 or 1989 or 1980. Those were different reasons for the failure.
I think there's a couple questions, Jay, that,
Yeah,
are
let's,
great. I always like to say, well, first I'd like to disclose I'm not an attorney, never passed the bar, but I rarely pass them though. So,
yeah,
uh, yeah,
why don't we go to some of those? Let's see if we can just sort of rattle through them and see. I think we'll answer a lot of questions of concern.
one is a practical one about, their, attorney escrow accounts that might be over $250,000. And one, I think that the liquidated banks, that now SVB has a bridge bank set up. The FDIC is working aggressively, probably to sell the assets and liabilities, and it'll probably be to a large bank. Actually,
They've
HS
tried to auction it twice already. Unfortunately, it failed.
Yeah.
Signature, they're not going to have an auction on. I'm not sure how reliable this is, but I have been told by an officer at Signature Bank that they're discussing mergers.
HSBC bought the
Yeah.
British business of SVB for I think £1.
Yeah.
A bargain basement price. And chances are there'll be some form of going to the large banks. There's very few banks, only a handful of banks that could really
Handle it.
absorb either institution. So if you have your deposits there over 250,000, the federal government already said that they would honor that. So on the deposit side, but we have a two-tier banking system in the United States, just getting to other banks. And we have the very large financial institution, which, if you do the top 10 financial institutions, they own 50 to 60% of all assets in the banking system. And then we have what's known as community banks, and community banks would generally, if you had $1 million deposit and you wanted to have FDIC insurance on the entire $1 million deposit, they usually engage in something known as reciprocal deposits. And it's run through like Reich and Tang or Intrafi, with the former Promontory Financial Network, where they actually lay off amounts over $250,000 to other FDIC insured community financial institutions. So your entire $1 million would be insured, and it would be transparent to you. You would have your lead bank, whatever bank that might be. In New York City, you might say, well, Alma Bank is my bank. I have $1 million in Alma Bank, and they engage in reciprocal deposits. And they would lay off $750,000 of that to other banks, and they would get $750,000 laid back to them from financial institutions to create that larger window of insured deposits. So the community banking system, which only owns about maybe 40% of all banking assets, typically use the reciprocal deposit system to extend FDIC insurance beyond their limits.
Yeah.
So I think that was one question.
Yeah,
right?
there are some tricky issues regarding who they're laying off to, and the New York State rules regarding who you can put an escrow account with, that I can reasonably guarantee nobody who wrote the escrow rules thought about, because I'm rewriting the textbook on the subject for the Bar Association, and I know that nobody thought about them, but that's going to become an issue. We'll fix that. But Jeff, I think what we ought to do, let me just run through some of these questions, because this is what people really care about. Can you clarify the FDIC insurance? Example: one adult 250,000, spouse 250,000, joint account of both 500,000. The insurance rule is that that the FDIC insures by what are called ownership interests. So if you have an account and your spouse has an account, and then you have a third account, the two of you own jointly, that's 3 different ownership interests, and you can get up to $750,000 worth of insurance, provided that you spread the money correctly between the 3 different ownership interests. one question I've been asked recently is, well, how about a partnership? If I've got a partnership and I got a law firm and we have 6 partners in my law firm, do I have $150,000 worth of insurance? The answer to that question is no. A partnership is a separate legal entity, and it has $250,000 worth of insurance with respect to its deposits. And that is, by the way, separate from the insurance of the 6 partners of the partnership. So they have their insurance, the partnership has its insurance, and that's it. Now, escrow accounts, I'm sort of, it's later down in the, sorry, I keep going like this. That's because I got a monitor over there. Later down, someone asks about escrow accounts. The rule with respect to escrow accounts is very specific, but it is interesting to me. It is true of escrow accounts or in any other fiduciary account. If a fiduciary has a deposit account at a bank, the insurance limit is measured by the beneficial owners, not by the fiduciary, with a proviso that will turn, you'll see in a moment, will turn out to be totally irrelevant for escrow accounts. If I have an escrow account at my firm, for my firm, and it doesn't matter whether it's an IOLA account or an individual escrow account, that is totally irrelevant here. If I have an escrow account and I have $1 million in it, and there are 9 different beneficial ownership interests, or let's call them sub-accounts. There are 9 different sub-accounts, and no sub-account has more than $250,000 in it, then all of the sub-accounts are fully insured, provided that they are different beneficial ownership interests. If I have 3 sub-accounts in the name of John Smith, one from deal number 1, deal number 2, and deal number 3, and it really is John Smith, and they total over 250, then only 250 is insured. However, and the caveat, which turns out to be totally irrelevant from the point of view of attorneys and escrow accounts, is that either the bank or the fiduciary has to have clear records, business records with language that's very similar to the for the litigators, the business records exception to the hearsay rule. You must have clear business records kept in the ordinary course of business, showing who owns how much. For attorneys and escrow accounts, that is totally irrelevant, because if you don't have that, you're going to get disbarred anyway, because you must maintain that, having nothing to do with FDIC insurance. But you must have business records showing that Mr. A is entitled to this much money, and Mr. B is entitled to that much money, and Mrs. C is entitled to 3 times as much. Whatever it is, so long as you maintain those records, your escrow account deposits are separately insured with. But, and this is important, and this is important practice point, if I have an escrow account and there are 2 sub-accounts, one for A and one for B, and both have $200,000 in it, and A also has their own separate account at the same bank, that account is combined with my escrow account to determine their personal insurance limit. So if I have an escrow account with $200,000 in it for Mr. A, and Mr. A also has a personal account at the bank for $100,000, those are combined, and he only has $250,000 worth of insurance. And the practice point is, make sure that you so advise your clients. This issue came up for those of you in the condo and co-op arena. This issue came up with the New York State Attorney General's office in preparing an offering plan for either a co-op or a condo, where they required an express disclosure of this fact in the condo offering plan. I believe, although I'm not sure, it is my understanding that one of the staff attorneys at the Attorney General's office knew this. Nobody else did, and he insisted, and they looked into it. And lo and behold, they discovered that was the rule and they require this disclosure. But you should make that disclosure as an attorney as well. You should tell your clients for whom you take escrow money, what bank you have it in. And in my view, you should advise them that they should add that to any personal deposits they have in the bank, in the same bank, for determining their insurance limit.
There's a couple
Now-
questions, Jay, on would their money be available if they were a signature or an SVB customer?
Yeah.
And the answer is yes.
Yeah,
And you can withdraw the money according to the federal government has stated that, we're open as of yesterday, they're open for business. You
Yep.
can withdraw and put it in another bank if you so choose. And if you so not to choose, chances are your deposit will be sold to probably one of the large financial institutions in the United States. So you could just sit tight and not withdraw your money because the government's standing behind those deposits. So I think you should feel confident there.
yeah,
And then there was a question on potential contagion banks. And I think the Fed's liquidity program that they put in place, if I don't even want to mention, because I don't want to be one of those people that cause some kind of run on a bank that might be the next contagion bank, that the liquidity put in place by the Federal Reserve should allow them to withstand what might be a surge in withdrawals, because the banking system as a whole is solid, credit quality is good, and it just caused a panic based on the very high level of uninsured deposits at the two banks that did fail.
yeah. They were to suggest that over 90% of the deposits at those two banks were uninsured deposits. In other words, were above $250,000 per beneficial ownership interest is extreme. It is a red flag, and I'm sure that it's something that the regulators are going to be looking at. It's very unusual for a bank to have, I don't remember what the number was, but there were billions of dollars held in the same name at Silicon Valley Bank. And that is a high risk situation because they could be withdrawn tomorrow. By the way, let's see, we have a number of other important questions. One, this is interesting only because it's the third time I've gotten this exact question. Are signature and SVB letters of credit being honored? Are landlords who are holding their letters of credit as security deposits able to put in a draw to access the proceeds of the LC? The answer to the first question is, which I specifically addressed with a senior VP at Signature yesterday, is that Signature is honoring letters of credit, that it is business as usual, and that there is no reason for landlords to be concerned. Are landlords who are holding letters of credit as security allowed to draw them down? The answer is you're going to have to look at the lease or whatever other document it is that gives rise to the letter of credit. If the landlord is allowed to draw down on the letter of credit under the terms of the lease, then yes, they can. And supposedly, I haven't done it yet, but supposedly it will get paid without any problems. But if the lease says you may only draw down on the letter of credit in the event that the tenant defaults in the payment of monthly rent, then no, you can't, because you would be doing something that could theoretically damage the tenant with no right to do it. But I would not, based upon the information that I have, and I have it by email from a senior vice president at Signature, in case you ever really need it, because they don't do it that way. They are paying letters of credit. Let's go. Let's see. How do we get our money out of Signature? The answer is the same way you would have done it last week. Are there legal issues around the venture capital firm that reportedly began the run on the bank by withdrawing their money and then urging their startup clients to withdraw? The answer is not that I know of. There is in New York, there is a relatively obscure provision in the banking law that prohibits people from bad mouthing a bank and causing a run. However, that statute has never been challenged, and to my knowledge, would not, based upon what I understand and have thought about over the years, it wouldn't withstand a First Amendment challenge. It just wouldn't. I'm sorry. That's a losing proposition. Maybe hard cases make bad law, and it would go the other way, but I would not rely upon the fact that a pundit said you should take your money out of Silicon Valley Bank or Signature Bank because they're shaky as a basis of a claim. What caused the large depositors to want to withdraw their money all at the same time? Virtually.
Twitter.
Okay. Social media and panic. Good old fashioned panic. Was it did they need to? Well, obviously, with 2020 hindsight, they didn't need to. But if you had asked me on Thursday, should I yank all of my money out of Silicon Valley Bank, which I didn't, assuming that I knew enough about Silicon Valley Bank prior to Friday, I would have said, yeah, take it out. It's not worth the risk.
That's what Peter Thiel did. And you know, it sounded like he had a lawyer on his shoulder, though, when he said, I don't see any downside from taking your money out of Silicon Valley Bank. That was his words to his, not amplified through social media, to his portfolio companies, because he himself was having difficulty. And actually the Founders Fund, I believe, took their money out that week.
And why did it happen at Signature? I haven't been able to track this down, but I was advised by a well-known former senior bank regulator that, in his view, the reason why there was a lot of uncertainty among the regulatory authorities regarding Signature was that Signature apparently issued a press release late last week to the effect that if there were another serious decline in the value of cryptocurrency, then Signature might be unable to honor depositor demand, and that's why the regulator stepped in. And he thought that might have been the I can't remember exactly which obscenity he used, but that it might have been the worst press release involving a bank shooting itself in the foot in the history of the American banking system. Whether or not that press release was issued because Signature's holding company is a public holding company and they sort of had to make disclosures is hard for me to say. But obviously, if your bank is saying they might not be able to meet withdrawal demand, you want to be at the front of the line, not at the back of the line, which is why Signature had the deposit withdrawals. Letters of credit, we already answered that. They're supposed to be okay. Did Signature Bridge Bank assume 100% of the assets and liabilities on the loan obligations of I'm not sure exactly what is meant by the question, but I'm going to guess, which is what happens if my client or I have a loan commitment scheduled to close next week and we've got a worst case scenario. My client has a time is of the essence obligation to purchase a piece of real estate next week. By the way, it's in the middle of a 1031 exchange, and if I don't do it, not only is it going to be delayed, but it's going to create a tax catastrophe. Signature is financing the purchase. Is Signature going to fund the loan? I have been told that the answer is yes, but my advice to you is that as soon as if you're in that situation, as soon as we get off this session, pick up the phone and call whoever it is who was the attorney representing Signature in the loan and make sure. But because now next question is, because Signature Bank is a new bank, are they bound by all the provisions in the credit agreement? If by that you're referring to lines of credit, the answer is I am advised that they, again, Signature says, I haven't actually drawn down on a line of credit at Signature in the last couple of days, but I am advised by Signature that they will honor and are bound by all line of credit provisions. And if you think about it from a lawyer's point of view, if they take advantage of the line of credit document, they are at least strongly, arguably bound by the obligations in the line of credit agreement, because they can't, if you don't breach, they can't breach. But a lot of line of credit agreements, and this is potentially of concern, but it does not appear to be, a lot of line of credit agreements aren't quite as obligatory on behalf of the bank as you would think. And the bank has a lot more discretion. I know, because I write them for the banks. And you want to be careful and make sure that you are comfortable that you're going to be able to continue to draw down. Now, as I said, the information we have is that Signature's not going to be around for very much longer, but the reason it's not going to be around isn't because it's going to fail. It's because it is a very valuable franchise, and somebody is going to acquire it by merger, and they're going to do it relatively quickly, and they want to maintain the value of that franchise. So if I'm Signature, I'm not breaching any agreements, and I am continuing to conduct business as usual to maximize the value of the franchise I'm about to sell. I'll tell you right now, Jeff, I'm about to say something truly outrageous. Maybe Jeff will work with me. I'd
Won't be
buy
the first time, Jay.
Excuse me?
Won't be the first time.
Never. We don't want to talk about when you used to be at Tucker Anthony. Sorry. If I could buy Signature Bank tomorrow, I would do it. I can't, because the other odd thing about banks is that buying and selling includes the obligation to pay for the liability, to fund the liabilities as deposits are withdrawn, and it's a little backwards from a normal purchase. But other than that, gee, would you? I'll ask everybody out there. We don't have that raise your hand function. Would you buy Signature Bank tomorrow for $1? And the answer is, if you wouldn't, you need to go back to somebody there raised his hand, I see. I would certainly buy Signature Bank for I'd pay a lot more than I'd pay more than than my entire net worth to buy Signature Bank. It is a valuable franchise making hundreds of gazillions of dollars, or at least the potential for it. As we said, it got shut down because of a liquidity crunch, not because it's fundamentally a money-losing proposition. So I am not overly concerned I'm not concerned at all, frankly, about whether or not the Signature franchise is going to be salvaged, because it's worth too much money. What can you do if one of these banks reneged on a commercial loan due to the crisis? Never. I'm sorry. I was going to answer that with a Yiddish joke, but I'll pass. But those of you who know it, the word beitsim is in the answer. It's not. It hasn't happened, and to the best of my knowledge, it's not going to happen. So I'll pass on the if portion of the question. How did the rapid increase in interest rates by the Federal Reserve impact on the failure of Signature and SVB Bank? My comment is obviously you're much younger than I am, because rapid increases is an interesting definition, because in the early 1980s, the prime rate was being adjusted 3 times a week, and the highest rate was, I think, 22 and a quarter. So it wasn't that rapid. But if we take the word rapid out of the question, oops, this keeps bouncing around.
Yeah, there's so many questions. I don't know if we'll get to all of them, Jay.
Yeah.
We only have like 4 minutes, I think.
Oh, yeah. Okay, I'll go.
Yeah.
How did the increase in the interest rates? The effect of the increase in interest rates was that when Silicon Valley Bank went out and bought fixed income long-term securities in the third quarter of last year, and then as you move forward, those securities dropped in value, and my guess is that Silicon Valley Bank management didn't want to sell them, because they would have been required to book a loss that you otherwise had hid on your income statement by classifying them as held to maturity. But as I've said a number of times in the last couple of days, I don't really know that to be the case. That we'll figure out the answer to that when the chief financial officer of Silicon Valley Bank is put on the witness stand by the lawyer who inevitably is going to represent the group that's going to sue the bank. And that's my suspicion, but I don't really know. Why did major investors? We talked about that. So if we have money in Signature Bank, ours or our clients, can we leave it where it is? I would certainly think that you can. It appears, based upon everything, and you might want to read, if you need some extra comfort, read the joint statement issued by the Treasury Department, the Federal Reserve, and the FDIC on Sunday. If you can't find it, send me an email and I'll send it to you, which basically says, yeah, we're going to provide the money to avoid the collapse of the world economy, which is what they're doing. Can you provide any guidance as to what will happen going forward in terms of maintaining and continuing accounts at Signature? I think we've covered that. I'm a real estate attorney who has my IOLA with First Republic. What would you recommend? What is my liability exposure if First Republic Bank fails? I haven't had a chance to look at why the stock of First Republic collapsed yesterday. So I don't know if it's panic or there's something fundamentally unsound. I have no reason to believe there is. What is your liability as an attorney under those circumstances? The answer is, I would be concerned about individual beneficial interests in excess of $250,000 if I concluded that the bank was unsound. I have no reason to believe that First Republic or any other bank is unsound. They are, and I would also have no reason to believe that the government would bail on one of those banks if they were what do you call it? Excuse me, if that bank was in extremis is a good term. How important it is to move the money to another bank? The answer is, I don't think it is. What about IOLA accounts? The fact that it's IOLA. Interesting thought. I'm sorry, Tom, this will be fun for you. You are permitted, I'll guarantee you this isn't right. You are permitted to maintain an escrow account only at a bank that has signed an agreement with the appellate division agreeing to provide bounce check reports in the event that you bounce a check on your account. I'm prepared to wager that what do you call it? That Signature Bridge Bank has not signed such an agreement. Whether or not the transfer of liabilities is such as to have assumed the obligation to file those reports, I don't know. Interesting technicality, something else for me to worry about with the appellate division after we get off this. But I wouldn't worry about it. I've given a couple of people advice saying it might technically, in the last couple of days, it might technically not be allowed, but no one's going to bust your chops over it. I wouldn't focus on that. Does the FDIC insurance protect you? Does the FDIC insurance protect you? We're discussing regarding IOLAs and apply to IOLA accounts held in a credit union. The answer is the credit unions are insured by the National Credit Union and National Credit Union Insurance Fund. I do not know, only because I haven't looked, but I am reasonably confident that the credit union fund and the bank fund have the same rules on that issue. Credit union regs 6. Sorry, I haven't done a lot of work for credit unions in the last couple of years. I don't remember, but you can take a quick look at the National Credit Union Insurance Fund regulations and answer the question. It took me about 15 seconds to find the comparable FDIC reg when I wanted to have it in front of me. You'll look at the insurance regs and you will find a section entitled fiduciaries, and look at that. What about sub-accounts? We answered, as we discussed, insurance of escrow accounts with sub-accounts. What about fiduciary? I mentioned that there are the escrow account rule there is no separate, although it is used once in the regs, there is no separate escrow account rule. It's a fiduciary account rule. There is, by the way, a separate rule regarding estates, because you have the problem of accounts in the name of the decedent and accounts in the name of the estate. And how do you do that? It's covered simply in the FDIC's insurance rules. And if you have questions about that, it's all of 3 sentences and it's very simple. If a client has,
Jay, we're a minute past the hour.
You're not allowed to say that, because I have a special deal with somebody who shall remain nameless, that we're going to keep going and answer questions.
Okay.
Shh. We weren't allowed to tell people that, because then you all would have kept asking questions. For PPP loans, it took 2 hours to filter through the questions. If a client has a money market fund, not a savings account, that one of the failed banks has hold as custodian, is that asset at risk? Depends upon what you mean by a money market fund. The answer, that gets into some SIPC issues. And is it really a money market? Is it a money market account? And is it really a custodianship? If it is really a custodianship and it is really a money market fund, as in what do you call a unit investment trust or an investment company, then that asset is not at risk, but it's also not FDIC insured. It's SIPC insured. So if you have that situation, you got to be careful. SIPC does not insure value. It only ensures that the asset is there. If the asset is still there, but it's only worth $1 and used to be worth $250,000, you're out of luck. But the effect of this whole mess on sweep accounts, MMDAs, and the like depends upon the specific facts of your sweep account or money market account. If you have money at signature, they're allowing transfers. If everyone continues to transfer out of these banks, the bank will. No, the resulting bank will, if people keep transferring money out, will it implode? And the answer is no. I don't think, Jeff, that's the whole purpose of the Fed facility. The Federal Reserve has said, we will dump more money into this if needed in order to fund deposits. If you want to be a good citizen, you don't panic. But as a fiduciary, it's very difficult for me to give advice telling people to just leave their money and relax and although I
Yeah,
believe that
so
I believe it
banks-
is the correct result.
Yeah, banks have many liquidity avenues. They don't have liquidity avenues at the volume that SVB or Signature were receiving a redemption request for their deposits, but the Federal Home Loan Bank system stood by ready to lend to banks. And I spoke to just yesterday because it was a big day in banking yesterday to see if there would be any contagion. And fortunately, the response was muted. I'm here at a banking conference and I'm asking CEOs all the time, what are your depositors asking you? It's like, we got a few requests. We were proactive in putting out a communication, and we got a few requests on the safety of their deposits at their bank. But the Federal Home Loan Bank system, I spoke to the Federal Home Loan Bank of Pittsburgh representative there, and they said, we stand by ready to inject liquidity into banks. And we really didn't have a big day yesterday in terms
Yeah.
of needing to inject liquidity in banks. So calm did prevail, which was really good. And I think that, again, banking is a trust system. So the government's actions combined with bankers' direct communications with their depositors ensured that the contagion didn't spread throughout the industry. That's where I think we're at right now.
Yeah. I'm how okay, there's a lot of letter of credit questions. I hadn't even thought about it until I got asked it yesterday. The answer is that they appear to be fine. And you can tell your clients that that you have been advised secondhand that a senior vice president at Signature Bank said not to worry, we're paying them. And it would be logical for them to do that and avoid killing the value of their franchise before they get merged out of existence. As I said, sweep accounts are a complicated question because sweep accounts could mean a lot of different things. It depends upon what it's being swept into. The difficult question with respect to reciprocal transfers of funds that Jeff was talking about, which was an idea originated, I believe, by Jerry Ludwig after he was ceased
Correct.
being the controller of the currency, and he decided he wanted to make money instead. Some of you may have heard of CDARS, CDARS, which is how that is accomplished or was originally planned to be accomplished. It is difficult to put the square escrow account peg into the round cedar hole because cedar stands for CDAR, which it's not cedar like the stuff you put in your closet. It stands for Certificate of Deposit Account Registry. So those transfers are certificates of deposit. And if you think about an escrow account, most of them are demand deposit accounts. You need to be able to pay out the money whenever you want. So whether or not you can use that system to provide additional insurance for escrow funds is going to depend upon how your bank manages those reciprocal arrangements and who they have the reciprocal arrangements with. If their reciprocal arrangement is with National Bank of Alabama, which I pick on not because it's Alabama, but because the former controller of the currency used to be the president of the National Bank of Alabama. I don't know offhand whether the National Bank of Alabama is authorized to accept escrow deposits from attorneys in New York. Not because they're in Alabama, but because they may not have signed the agreement with the appellate division. And as an ethical matter, it is the attorney's responsibility, not the bank's responsibility, because banks can't be regulated by the court system. It is the attorney's responsibility to make sure that your bank is on the approved list of banks that is published by the appellate division that are approved to accept escrow deposits. I don't want to cause an internet crash, but after we're done here, you should all go to your to the appellate division website. Sorry, I didn't think of that one would be relevant. If you need it, I have the link, but I have too many things open on my computer right now. If you need it, I'll show it to you. I'll send it to you. You can check on the website and make sure that whatever account you have your escrow, whatever bank you have your escrow deposit in, is authorized to accept those deposits. And if you want to engage in that reciprocal arrangement, you got to talk to your banker and make sure that the reciprocity, I don't know what word to make up to the counterparty, is also authorized. What about Taunton trust accounts? That's covered by the rules. I read it yesterday, but it wasn't very important, so I didn't focus on it fully. Taunton trust accounts, I believe, are because they're technically custodianship accounts. Oh no, I'm sorry. Trying to remember exactly what I read. I just sort of glazed over it. I believe that it's based upon the beneficiary, not based upon the trustee. But again, if you search the FDIC's regulations and look for the word Taunton, it's right in there. It will answer the question for you. I hold numerous accounts at Signature in a fiduciary capacity. Several accounts exceed 200. Should I be concerned? The answer is no, not at Signature, because they lifted the limit and they're dumping money into the system. How much risk is there to a brokerage accounts at other regional banks? Brokerage accounts are not deposit accounts. They are brokerage accounts, and what you have is SIPC insurance, which insures. What's the SIPC number now? I think it's 600,000. Jeff, do you know offhand? I know at one point it was 600.
Yeah, that's that's related to the share
Yeah,
count. They're
right.
not insuring the absolute dollar value.
Yeah,
like an FDIC insurance is.
Yeah, that they're not, and that has nothing to do with this, because that's a securities account in which there are securities. That is not a deposit account where there is FDIC insurance. If you think that you have FDIC insurance because of your security account at a bank, you should have a little chat with your banker and look at all the documents they gave you. And if they didn't give you a document that said it's not FDIC insured, you should ask them about that and then refer them to me so that I can rewrite their documents.
A lot of brokerage companies have banks, like for example, Raymond James has a bank and Charles Schwab has a bank. So they're FDIC insured banks, and a lot of them do put the cash portion of a brokerage account in those banks, and they would be FDIC insured.
Yeah, I mean, I have a brokerage account with Merrill, and it is owned by Bank of America, and there is a cash portion. The cash portion is deposited at Bank of America, and that is FDIC insured. But if my brokerage account is invested in a unit investment trust or in an investment company, even a cash equivalent investment company, that is not FDIC insured. So make sure you understand that. Our CDs affected a child. The answer is there with respect to certificates of deposit, there's no change. Need that. Should you keep a portion of a $400,000 real estate contract deposit you're holding in escrow in? Should you split it between two banks? And the answer to that question is, as we said, it is a question of an assessment of the strength of the bank. If I were, I'm not aware of any bank in New York right now that is such a high risk that I would be worried about it. You can do an assessment. You have to understand, banks have lots of capital. I don't remember what the number is at Signature, but we're talking billions of dollars of capital. They are not A, they are not unsound, and B, it is extremely unusual and that and required some of the crazy stuff that that happened with respect to Silicon Valley Bank for a bank to be closed quickly.
Yeah, in a run on the bank, Jay, I mean, capital is not king, it's a court jester. Because nobody could withstand the amount of withdrawals that Silicon Valley Bank received in a 1 week period as a percent of their total deposits. They just don't keep that amount of liquidity. They wouldn't be able to make any money by keeping that amount of liquidity. So you know, any bank that was mentioned in this call are all very well capitalized. And you know what, Silicon Valley Bank was well capitalized on a regulatory capital ratio, and so was Signature Bank on a regulatory capital ratio. So, you know, again, it was the run on the bank. It was the panic that ensued. It was just an aberration of what happened. And I think as attorneys and, you know, me as a consultant to banking industry, injecting calm into the system is very important so that there's no contagion.
Jay, I want to thank you guys both. If you want to stay on, that's fine with me, as long as the people at the state bar will allow it. But
eventually they'll kick us out, but that's okay.
Well, I want to thank
now
you.
We're getting to some very interesting questions, by the way.
Okay, well, I'll let you and anyone else who wants to stay on, but I have to go. I didn't realize it would last so long.
Okay,
so thank you.
Okay. We've got some very interesting technical questions here. I like this one. The Federal Reserve reduced the reserve requirement to 0 in March of 2020. Gee, nobody else knew that. I didn't know people actually knew that, which they did, by the way, because of COVID, and we'll talk about that in a moment. Do you think they will reverse this decision in light of Signature Valley Bank and Signature? Okay, just so this may require a little bit of background. The Federal Reserve has a requirement and has had it, I don't know, as long as I've been around, that banks maintain reserves with the Fed against their demand deposit accounts. So checking accounts, let's call them for the moment. If I have checking accounts, if I'm a bank and I have $500 million in checking accounts, I have to have a certain portion of that. Portion is the wrong word. I have to have a certain amount of money deposited with the Federal Reserve as against those transaction accounts. The calculation it's based on tranches. I think there's a $29 million tranche is 0, and then there's 0%. It goes up from there. And I've been thinking about this, and I haven't heard anybody else talk about it. It's why I find it interesting that someone asked the question. And maybe Jeff has some thoughts on this if he's still on. Did the fact that there was no reserve requirement and therefore Silicon Valley Bank didn't have to post what I suspect would have been about 10% of its transaction account volume with the Federal Reserve, did that contribute to the liquidity crunch? My gut tells me it has to have, but
my gut tells me the opposite, Jay. But
okay, go ahead.
I don't think it would have made a difference. It just would have probably made a difference because the Fed now pays interest on that money.
That's true.
I'm not sure exactly how much money they actually had in the Fed Reserve account, which is that pool of money where the Fed could say, okay, we have this much money coming into Silicon Valley Bank, and we have this much money coming out of, and therefore the net is what Silicon Valley Bank has to settle on for the day. I would doubt it. It might just impact the size of their bond portfolio book more than anything. It was
yeah. Well, that's what I was thinking was if they had fewer securities investments, maybe they'd had more cash. I think that the correct answer to the question is probably for a normal bank under normal circumstances, it would have helped. But as Jeff has said a couple times, and he's clearly right, this was such an extreme deposit withdrawal demand that nobody could have withstood it except for the Federal Reserve itself, which would have just printed money. But the question was, is the Fed likely to reinstitute the reserve requirements? And I don't know, but I've been wondering about when they were going to do that anyway, because it comes up in a couple of other circumstances. It was originally, just so that people understand, in March of 2020, the Federal Reserve dropped the reserve requirement to 0. Why? Because the reserve requirement reduced the ability of banks to lend money, and because they've got to have it posted as a reserve, they can't lend it out. And they dropped the reserve requirements to dump more money into the system to help stop the economic problems caused by COVID. Are they going to reinstitute the reserve requirements because COVID is mostly over? It depends upon whether you are whether you believe Milton Friedman or John Kane, who your favorite economic analyst is. I think there are people who will argue that they should be reinstituted, and for this reason and for a lot of other reasons, people will argue that the reserve requirements are silly. So it's difficult to say what they will do. If I had to make a bet, gun to my head, I would say that they will reinstitute some reserve requirements in 2023, but the cause of that could be a variety of factors.
Yeah, it would be a guess. Bureaucrats are very adept at implementing solutions that wouldn't have solved the problem that they're trying to solve.
Well, that's
just so they could say they did something.
That's why I am guessing that they will. That's precisely why I'm guessing that they will reinstitute. By the way, just so that in the same vein, one of the individuals who was going to participate in this seminar, who is currently the executive vice president of bank, former bank president and former bank CFO, who really gets down in the nitty gritty about managing liquidity, was unable to join us because the state regulators are calling every single bank in the state of New York to give them a liquidity checkup, and certain things you don't do. And one of the things you don't do is say to the regulators, "I'm sorry, I'm busy. I'll talk to you tomorrow." Needless to say, the regulators called him yesterday afternoon and said, "We want to talk to you at 3:00. So he was unable to attend, but they are checking. But on the other hand, it's 2020 hindsight. It's not 20. They are locking the door after a horse has run out of the corral, is over the hill and way over there with respect to some of the banks. But they are checking to make sure that everybody is maintaining sufficient liquidity and is not going to be a problem. Now, this guy specifically said to me, "You understand that our call is at the end of the day on Tuesday, and they have rank ordered their phone calls starting with first thing Monday morning. So we're clean and they know it because they're not bothering with us until the end of the day on Tuesday." But I suspect that that the regulators will be making sure from everybody, with everybody, that they understand that they don't want banks to hold on to held to maturity securities to make their income statements look good and screw up their liquidity as a result. Whether that is what actually happened, I can't tell you, but that's what I'm sure that's what they're telling people. I don't actually know because, like I said, he was on the phone with the regulators while we were talking. In addition to the FDIC, let me
Jay, I must jump. I just wanted to
Go-
say goodbye to everybody and thank you for the opportunity to talk to you. All right?
sure.
All right.
Now go out. I told you, go scuba diving at Molokini Crater. It's really nice. In addition to the FDIC. There is a question about additional insurance, and the answer is no. The question is not presumes something that doesn't exist or is a misunderstanding, but the answer is no. It for the only difference between an IOLA account, an IOLA, and a regular escrow account or a regular deposit account has to do with where the interest gets paid. There is no effect on FDIC insurance. They're all treated the same. It's just who's the beneficial ownership. What is the beneficial ownership of the trust relationship giving rise to the escrow account, and the beneficial owner gets the insurance. This can create some interesting questions that, to be honest with you, despite spending more time than I wish I had yesterday and today researching the question, I can find no published answer, which is in a real estate transaction when a buyer and a seller put up money, or even worse, in a loan transaction when a borrower posts an escrow, a repair escrow. Who owns that money? The answer is debatable. Maybe there are two owners. If I look at the rules, there are not two owners because two owners assumes either joint tenancy or tenancy in common, and neither of those exist. But so I think that with respect to escrow accounts, it's going to be who put up the money, not who might ultimately get it. But that is not as clear as it could be. Do you need sub-accounts for escrow? The answer is no. You do not need sub-accounts. All you need is absolutely clear records. And they can be your records. They don't have to be the bank's records. My signature wires are not going out. It has been a day already, and my client's deal is about to implode. Call me afterwards, and I'll give you the phone number of. It doesn't seem right, but okay. I'll give you a contact information for the guy who told me not to worry and that they would be sent, and you can bludgeon him as much as you feel like. I would give it to you right here, but unfortunately I have about 37 screens open and I don't know where it is, but you can call me afterwards and I'll give it to you. Citation for the FDIC rule about decedents' accounts and estates. Okay, let me just see. I know when I sent that one a little after midnight last night, so it'll be easy to find. Hold on just a second. I'm not sure. I can't find the outgoing email, but the FDIC insurance rules that I keep referring to are 12 CFR 330, Part 330. Part of on the issue of partnerships, it's Part 330.11B as in boy. I can't find the answer to the exact site on the estate question, but it's I think it's 12 CFR 330.8, but it's really easy to find because it's just a heading. 330 is an entire part, and there is a I think it should be easy to find, but I think it's 330.8, but I can't find the site right now. What's that about? Sort of, let's just see. What about accounts open in connection with VC funds or SPVs? What about them? It's the same rules. So long as an entity is engaged in a separate business, separate and apart from any other entity, which is a rule that was created solely to avoid doubling up insurance by creating shell companies. It doesn't matter. It's a VC fund. It's a special purpose vehicle. It's whatever it is. You measure the what do you call it? You measure the insurance the same way. Oh, every time I'm about to say goodbye, somebody calls. If the Fed provides liquidity, won't the obligation for uninsured deposits lead to inflation over time and indirect taxation through inflation? Okay, I need to put on my tinfoil hat for that one. The answer is no. And the reason the answer is no is that the assets are there. The Fed's going to provide cash. The assets are going to be liquidated and the Fed is going to be repaid. It's the same concern that people wrongfully had with respect to TARP money. They said, oh, it's going to be terrible. There's going to be all this, what was the number, $700 billion flowing into the economy for no good reason, and it's just going to cause inflation. And the answer is it didn't. And the reason it didn't was that it was repaid. And the government made money, by the way, on TARP. Not only that, of course, it also avoided a recession. So I think that that the idea that the Fed printing money and then burning it later on when it recovers on the signature assets is going to have no effect on inflation. But I'm a lawyer, I'm not an economist. And I'm not a Friedmanite either. So that's my view, but I could be wrong. Are there additional protections for IOLA accounts, say, as compared to escrow? The answer is no, no, and no. IOLA accounts are the only difference between an IOLA, and I do this lecture too. For those of you who studied mathematics in high school, there's this Venn diagram. Oh, I forgot to comment about my grandson's Jackson Pollock behind me. There's this Venn diagram. And it's a big oval, and it's called escrow accounts. And inside it is a smaller hole. Actually, it's pretty much the whole thing, but not quite, called IOLAs. There's no difference between regular escrow accounts and IOLAs, except for who gets the interest and the procedures to make sure that the interest goes to what's it called? The IOLA fund. It's not, by the way, another common misconception is that it goes to the lawyer's fund for client protection, which is the money that we pay every 2 years to register as a lawyer, to deal with the fact that some of the members of our profession happen to be crooks. It has nothing to do with that. It goes to the IOLA fund, which uses the money to fund legal services type activities. Other than that, they are the same. Can you have my contact information? Sure. I'm sorry, I'm looking at send me an email. It's JLH@GDB, George David Boy LAW.com. If you want to, I'm posting a bunch of blogs on the subject, one of which went up yesterday regarding crisis management, and the other of which is going to go up later today on some of these issues. If you want, you can find it there as well. If a lawyer has there was just I'm sorry, these stuff is bouncing around. If SVB or Signature is a lender in a lending syndicate, is agent permitted to implement defaulting lender provisions as a result? That's a fascinating question. Let me tell you about bringing down the entire world airline industry after 9/11, the answer is it depends upon what the syndicated credit agreement says. We were asked the exact same question as the attorneys for the lead lender in the Asian sub syndicate for the, I think it was American Airlines, but I'm not sure which one. It was a long time ago. For the American Airlines line of credit, did we have to fund? When American Airlines came to the syndicate and said a week after 9/11, we need cash. And we were asked to look at the question on behalf of our client, the head of the Asian sub syndicate. And the answer, the process that we had to undergo was to review the syndicate documents. Again, this is all basic contract stuff. Review the syndicate documents and determine whether the leader of the syndicate has a right to kick him out or not. Whether or not the transfer from old signature to new signature is a breach of the agreement. It probably is, but there's probably some federal, the equivalent of a bankruptcy provision that says transfer in bankruptcy does not, does not violate a prohibition on transfer in an underlying contract. I believe there's a similar provision for FDIC resolutions. It's a matter of contract question. By the way, in the case of American Airlines, there are two questions. One is, and it probably applies in this case as well. One is, are you permitted to refuse to fund? And the other one, which is a little bit more edgy, is, do you have to refuse to fund? Do the documents for the lead lender of the syndicate prohibit you from funding? And we never had answered the question because the syndicate was politely called by a couple of very important people around the world who had titles like Secretary of the Treasury and Prime Minister and the like, and said, we don't care what your analysis is, you're funding. And they did. But did Singer, I think that's about it. Does your escrow? Yeah. I think that's it. The last question being, if your escrow account does not have sub-accounts, do you still go by beneficial owners? The answer is yes. Sub-accounts are merely a matter of convenience and nothing else. They're very convenient, I might add. You should have been around. Some of you may not have been around before bank core data processing systems provided for it, and that was a real pain in the neck. I'm going to assume that we're done. Tara, are you there?
Yes.
Okay, I'm gonna assume that we're done, and if anybody has any further questions, you can send them to me by email, or otherwise find me on the internet. You can't call me in my office because I'm not there. But hopefully this too shall pass, and I strongly believe that it will. Vendors and counterparts with contracts with a bridge bank are legally obligated to continue to perform. Yeah, someone whose name I recognize, maybe in-house at a bank. I don't want to say. The FDIC just issued a financial institution letter which provides that vendors and counterparties with contracts with the bridge bank are legally obligated to continue to perform under the contracts. And the bridge bank is obligated to and has the full ability to make timely payments to vendors and otherwise perform its obligations. Yeah, I should say, because I've only been asked this a couple times by borrowers, do I have to still pay my loan to Signature? The answer is yes. Sorry, you don't get a freebie because of this.
And Jay,
And,
you do have one final question. It's tell us about the painting.
oh, I said, the painting is my Jackson Pollock knockoff performed for your enjoyment by my grandson. I have won the award as the best grandpa in the world. And the reason for that is that I have a room in my basement. It used to be my wine cellar, but then we built a real wine cellar. So we have the passive wine cellar room, which is now the splatter painting room. We take canvases downstairs. We take lots of paint, and my grandson takes interesting devices like paintbrushes, chopsticks, hands, spoons, and he flips paint at the canvas. And I strongly recommend this to everybody who has grandchildren, because he was 6 or 7 when he made this, I forget exactly, and he loves it. So if you have grandchildren and you want to share the award for the best grandparents in the world, set up a splatter painting room. They love it. Any other important questions, Kathy?
Nope. And thank you again, Jay Hack, for doing this program and turning it around on such short notice. We do have just over 100 people still tuning in. You did get to most of the questions, but we will forward you the full Q&A log. And if you are able to, we can post those as part of the materials. Just a reminder to our registrants, all of the materials, there are a few handouts from Jay Hack and his panelists. They are available at the Learning Dashboard. If you log into the New York State Bar Association website, click on your learning dashboard, click on the course title and the materials, you will see the handouts and outlines for today's program. So thank you again to the Business Law section and its Banking Law Committee and Jay Hack for coordinating and making today's program possible. Thank you for sharing your time, talent, and expertise.
Have fun, everybody.
Thanks, Jay.